Okay, in this problem we're going to go over the basics earnings per share and with a simple capital structure. So the problem says the following condensed financial statements for HBC Inc. were prepared by the accounting department. And we have the HBC income statement for 2011. We have the HBC balance sheet. And our instructions for the problem are: compute the basic EPS under each of the following independent assumptions that the company has a simple capital structure. So for number one, there's no change in the capital structure in 2011. On December 31st, 2010, there were 160,000 shares outstanding. On May 1st, 2011, 60,000 shares were sold at par. And on October 1st, 2011, 30,000 shares were sold at par. On December 31st, 2010, there were 200,000 shares outstanding. On July 1st, 2011, the company issued a 25% stock dividend. So, for number one, we just need to compute the basic earnings per share. So the first thing that we need to know is that there are 250,000 shares authorized, issued, and outstanding. So that comes from the balance sheet. Then we need to know net income. So after income taxes right here, we have income from continuing operations right here. That's 930,000. Then we had an extraordinary loss of 80,000. And then we had net income of 850,000. So to compute basic earnings per share, we'll come down here to number one, and this is our entry right here. You have the number of shares outstanding, 250,000. This is the exact same information. Income from continuing operations, 930,000. Extraordinary loss of 80,000. And net income of 850,000. So to compute basic earnings per share, we're just going to divide the 930,000 by 250,000. That's the number of shares, and we get 372. Then we divide 80,000 by 250,000, and that is 32 cents, or a loss of 32 cents per share. So on net income, you have on net income you have 850,000 from this number right here, divided by 250,000 shares. So you have $3.40 when you subtract the loss from continuing operations income. So that's number one. Now number two right here, on December 31st, 2010, there were 160,000 shares outstanding. On May 1st, 2011, 60,000 shares were sold at par, and on October 1st, 2011, 30,000 shares were sold at par. So for number two, these are our numbers. You have the number of common shares expressed as a weighted average number of shares. Now from January 1st to April 30th, that's 4 months. It's January, February, March, and all of April. So you have the 160,000 shares times 4/12, because we want weighted average number of shares. So that number gives you 53,333. From May 1st to September 30th is 5 months. So we take 220,000. Now 220,000, if you look at the information from number two again, 60,000 shares were sold on May 1st. So you add the 60,000 to 160,000. That gives you 220,000. So for 5 months out of the year, you had 220,000 shares outstanding. So 220,000 times 5/12 is 91,667. Okay, and then if we go back to number two, we had 220,000, and we added 30,000 more shares on October 1st. So from October 1st to December 31st, we had 250,000 for 3 months. 250,000 times 3/12 is 62,500. Add those up, and your weighted average number of shares is 207,500. So we go back to the income numbers, and you have from continuing operations 930,000 divided by 207,500 equals 448. The extraordinary loss, 80,000 divided by 207,500, it gives you a loss of 39 cents a share. Then you have the net income per common share, 850,000 divided by 207,500. That gives you $4.09. So on number 3, on December 31st, 2010, there were 200,000 shares outstanding. On July 1st, 2011, the company issued a 25% stock dividend. So on number 3, we don't really have a calculation. Well, if you go through the calculation, this is what you'll find out. This ends up being the exact same as number 1 because the July 1st stock dividend increased the number of shares to 250,000, and the stock dividends retroactively affect the shares. So, adding 25% more shares to 200,000 is 50,000, so you have 250,000, but on a stock dividend you have to retroactively, or you just apply those retroactively to the whole year. So you calculate it as if you had 250,000 shares the whole year, which would just be these same numbers as number 1. So that is how you do that problem with finding basic earnings per share.